Hello everybody and welcome to part 2 of our Module 13 discussion for managerial accounting and budgeting. With this part we are going to cover the remaining budgets from the overall master budget. We're going to start off with the labor budget, and remember this is after we've completed the production budget and we also completed the materials budget. The labor budget is next, and it can be completed at the same time as the direct labor and manufacturing overhead budgets, and for that matter the materials budget. They don't rely on one another. They all rely on the production budget though. So for the labor budget we need to know three things. We need to know the expected number of units to be produced, which came from the production budget. We need to know how many hours are required per unit, and we need to know the cost of each hour of labor. Now the good thing with the labor budget, unlike the materials and production budget, is that we do not have any beginning or ending inventories to worry about. Labor is either used that period or it's not used at all. You can't really store up labor by itself. In fact, when you store it up, it's used in production. So we're going to use it that period, no beginning or ending inventories. So the budget's pretty straightforward. We carry over the beginning or the budgeted units to produce from the end of the production budget. Notice we no longer need July or August. We're just dealing with this quarter. We're going to multiply each quantity by 2 hours of labor to give us the number of hours we actually need. Then we're going to multiply it by $12 per hour to get our budgeted direct labor cost overall. Then everything can be added up for the quarter except for the items we multiply by, the number of hours of direct labor and the rate. But everything else is indeed a sum. And next up after the labor budget is the manufacturing overhead budget. Now this is one of two different overhead budgets we're going to be dealing with. This one specifically deals with manufacturing costs or factory costs, production costs. Now most companies have a little bit of both fixed and variable manufacturing overhead. Now again, this has to occur after the production budget, and I would also go so far as to say, depending on how we allocate variable overhead, we may have to wait until the direct labor budget is completed as well, because as we'll see in this example, we're going to use direct labor hours to allocate overhead, so we need the direct labor hours from that budget. Again, you're going to have both variable and fixed manufacturing overhead. We need to know how this company allocates their variable manufacturing overhead. In our simple example, it's going to be direct labor hours. You might see a company using machine hours. You might even see a company using activity-based costing, and you just need to use whatever that driver quantity is. If they just use one driver like labor hours or machine hours, you need that quantity, and you also need the variable overhead rate for that type of hour. Activity-based costing gets a little more complex because you're going to deal with multiple rows of overhead, of variable overhead. You can certainly still do it though. So in this example, we have April, May, and June, and then the quarterly total. Notice we don't have to worry about any beginning or ending inventories here either. And we have a little note here saying that the variable manufacturing overhead is being allocated based on direct labor hours, so that makes it nice and easy. So the very first line of this budget is going to be the direct labor hours for each month from the direct labor budget. Then we're going to multiply that by the variable overhead rate per hour to get total variable overhead, dollar-wise. Now again, if they used machine hours, we would just adjust it and use that instead. If they used activity-based costing, we would just have this calculation, these three lines, or I guess I should say these two lines, showing up multiple times for the different drivers and the different rates. And then of course you're going to want one nice subtotal. Now for fixed manufacturing overhead, I will say there are a couple of ways this could happen. This could be just a list of all of your overhead that has been incurred or you expect to be incurred throughout the quarter. Or some companies also allocate their fixed overhead, so they might have a driver there as well. They might have a separate rate for fixed overhead to be allocated as well. So that's just something to note. We're going to have a subtotal of the fixed manufacturing overhead, and then finally a total budgeted manufacturing overhead expense. Now we're going to get into the selling, general, and administrative budget. This is virtually identical to the manufacturing overhead budget. Again, it's going to have both variable and fixed costs. Now, one other thing I wanted to mention with the manufacturing budget, notice we had depreciation separated out. We're going to need that separated out in just a bit. So we would need the depreciation to be separately considered because it's not a cash payment. For the selling, general, administrative budget, we really need to know two different things. We need to know the variable overhead rate, and we obviously need to know what cost driver is being used to allocate that variable overhead. Now, this is where it's a little bit different from the manufacturing overhead because it's often going to be based simply on the number of units sold or even dollars sold, a percentage of the dollars sold, as opposed to labor hours or machine hours, which were used for the manufacturing overhead budget. That's where the difference is. And again, the fixed overhead, think of things like, well, let's go back to the variable overhead. Think of things like a sales commission. You get a 10% commission on everything you sell, for example. Or there might be variable utilities for the store, or even the headquarters, the administrative type. Fixed overhead might be the sales salary, or the salary of the CEO, the building depreciation for the headquarters and the stores. So sometimes those are just listed out. Sometimes they're allocated out based on the number of units sold, and we would have two different lines for that. So I already talked about some of the types of fixed overhead costs: depreciation of buildings and or equipment, office or store salaries, salaries for the office or support staff, and rent for the office or store buildings. Again, this is not production, though. That's the key thing. The variable overhead costs might be utilities for the store, for the headquarters, supplies if we use it in the office, hourly wages for support staff in the office or the store, and again, sales commissions. These are based on how many units we sold, for example, or the dollar of sales. So this might be what the selling, general, administrative expense budget for the quarter looks like. Notice they have, again, the number of units sold. That's going to be their cost driver, multiplied by 3.25 per unit sold. Variable overhead rate. They get a total variable overhead, and then they list out their various types of fixed overhead, get a subtotal there, and finally we have a grand total of all the budgeted selling, general, and administrative expenses we had. So now we have the overhead. Now we've completed our production budgets, all the overhead budgets, and now we're going to go into what is potentially the most complex budget overall, but it's also the one we're probably most familiar with, a much simpler version in our personal finances. This is the cash budget. This particular budget is considered to be both an operating budget as well as a financing budget, and it has both pieces that come into play. Now, I will say the cash budget is going to be broken into a cash receipts budget and a cash disbursements budget. We're going to see both sides of that. It brings together all the financial goals, all of our needs, and in some cases you're going to have a company that says, hey, we don't want to just make sure we're above zero cash. We want to have a minimum amount of cash, a desired cash level that we never go below. And that means we may borrow to get enough money to keep that cash level. It's just a level of protection. They want to make sure they always have enough cash to continue operations. What we're going to see at the end is that this cash budget is going to tie to the balance sheet. We bring forth the beginning balances from the earlier balance sheet, and then the ending cash balance shows up on this year's balance sheet. So we'll see how all of that comes together. Now, what I'm showing you now, I'm going to start kind of backwards. I'm showing you the overall cash budget, and then we're going to piece it out and talk about the cash receipts, cash disbursements, and then the financing side of things. But what you'll notice here is that even though there are no beginning or ending inventories per se, We do have each individual month and the ending cash balance for a particular month carries forward to become May's beginning cash balance. It's not an inventory per se, but for the most part, everything is just working all the way down the month, and then at the very end, you carry it over and you start the next month. There are some things that you can't do for 1 month until you've completed the next month. So notice we have cash receipts, which we're going to have to identify how we came up with that. It's going to be supported by the cash receipts budget. We add that into the beginning cash. We get the cash available. We subtract out cash payments or disbursements, which again, there's a separate schedule that supports that we'll see. And then we get the ending cash balance before considering financing. We compare it to our desired minimum cash balance. And like in April, we're above the $20,000, so there's no borrowing to worry about. By the time we get to the end of May, we're projecting that we're going to be negative with cash. We're projecting that we're only going to have $76.60 in cash, whereas we want to have $20,000. So we're $12,340 below where we want to be. So again, even though it seems a little odd, we're going to borrow money just to have it sitting in our ending cash balance. A lot of companies do that. They want to have that minimum cash balance. So then by the time we get to the end of June, we're going to have $46,860 of cash, which is well above the $20,000 minimum. We have $26,860 extra. So what we can do now is pay off that borrowing from the last time, plus the interest that we had. We still have plenty of cash on hand at the end. So now let's dig in and look at the cash receipts and cash disbursements budgets separately. The cash receipts budget usually comes first because we need to know how much we have coming in, how much we plan to have to make sure it's enough to support all of our purchases. Now, again, we saw the overall budget, and again, the two budgets get combined. We roll the cash receipts budget into one line on this overall cash budget, but we need to see the support for it. So first of all, keep in mind cash receipts, it's generally related to sales. That's the vast majority of the reasons we have cash receipts. So we do need to know the sales amounts from the sales budget. But again, it's not usually as easy as saying, hey, we sold $1,000 this month, we're going to collect $1,000 this month, because most of the time companies offer sale and payment over time. They have accounts receivables, they have credit sales, but we do need to know how much of it is indeed going to be an immediate cash sale. We'll collect that sale this month. How much are credit sales that are still collected in this current month, maybe later in the month though? How many credit sales dollars do we have that are collected 1 month later, and maybe even 2 months later if we allow it? And unfortunately, when you allow payment over time, you're generally going to have a situation where some customers don't pay at all. So there we have bad debts that we're dealing with. So we're going to start off with a current month beginning accounts receivables. It's the deferred amounts from last period that are going to be collected this period. And we're going to end with an accounts receivable balance that will carry over to next period. That ending accounts receivable goes to the balance sheet. So now let's go ahead and take a look at the cash receipts budget specifically. Now, this is for the quarter, April, May, and June, and then of course we'll have a total line for each quarter. But the point here, we need to know what the collection pattern is for this period, for this company. In this case, if you read through the details, they'll usually give you a little introductory paragraph talking about it, but here we're just going to lay it out. There are 30% of every month's sales are going to be collected in cash. The other 70% of a month's sales are credit sales, and they're going to be split 60-40 over this month and next month. That's how this situation is working. Now, I want to mention here, there are a variety of formats you can use to calculate this. The way I've presented it here is just to make it very clear which month's sales we're collecting when. And of course, we have a total cash receipts at the bottom, which flows to the cash receipts overall budget. Now, notice also I have an informational only section showing the beginning accounts receivable balance, the ending accounts receivable balance. This is more for the balance sheet itself. But here we're going to see sales from the sales budget, the dollar amounts pulled forward, and then it's a question of when do we actually collect it. So by the way, for April, we would have needed to know March's sales to determine how much of March's sales were going to be collected in April. But let's just assume that's a given amount. This would have been March's sales multiplied by 70%, multiplied by 40% collected in the next month, which of course is April. So this is given to us. April, 30% of April's sales are going to be cash sales collected in April. 70% of April's sales multiplied by 60% are going to be collected in April, with the other 40%, in other words 70% times 40%, collected in May. Now, May's cash sales will be 30% of May's sales. The May credit sales collected in May will be 70% of May's sales multiplied by 60%. And again, the other 40%, so 70% times 40%, will be collected in June, along with the rest of June's sales. So we add up the sales from a particular period. We find the total cash receipts for each of those months. And then, again, we can fill in the beginning accounts receivable balance, which for any given month, the beginning balance will come from last month that we're now collecting this month. So that was the given for March that was given to us. The ending accounts receivable balance, you have to look at which sales in April were not collected until the next month. That's where that comes from. So now let's take a look at the cash disbursements budget. This is after the cash receipts generally, and then again we combine this with the cash receipts budget to prepare the overall cash budget. So with cash disbursement, there tends to be many more cash disbursement items we make as opposed to cash receipts. Usually cash receipts is just simply collections from customers, but there are a lot of reasons we might need to pay money. So we need to know the material purchases amounts from the materials budgets. We need to know the labor costs. We need to know the manufacturing overhead cost, but we're going to carve out depreciation because that's not an amount we're paying cash for. We need to know the selling general and administrative expense because, again, that's not a cash depreciation amount. We're not going to pay that cash. For the cash disbursement budget, for the materials specifically, we also need to know the payment pattern. Usually it's a little bit easier. It's just a certain percentage this month, a certain percentage next month. We don't have the 3 different categories usually. And again, it's going to depend on what credit period the vendor gives us. We're not going to have any bad debts ourselves. We certainly shouldn't plan for that. Not paying a certain percentage, that's improper business. And again, we're going to have an informational account payable, beginning and ending balance. That carries forward to the balance sheet. What I want to mention, though, is there's another method that you can do to show that. Instead of having it down at the bottom, you can actually integrate it into your schedule, just purely informational only, again. So, by the way, since our inventory purchases, we're going to, as you can see here, pay it 40% one month, 60% the next month. Now, we didn't list out a purchase line, so we'd have to go back to the purchase budget to get it. Either format is fine, but we're paying 40% of April's purchases in April. The other 60% we're paying in May. And you keep going down the list there. Now, this beginning AP balance for April, that would have been March's purchases times 60%. We're paying them in April now. So we're paying both of these items for materials this month, plus we're paying labor from the labor budget, plus we're paying manufacturing overhead after having carved out the depreciation. Same thing with selling, general, and administrative. When you add all those items up, we get the $640,975. It's the same situation for May and June, and again, we get a quarterly balance. Now that takes us to the end of our discussion of budgets. Now one thing I do want to mention, I don't have any slides here for this, but for the income statement and the balance sheet, you'd be carrying forward the cash would go, the ending balance of cash would go to the balance sheet, the ending balance of inventory would go to the balance sheet, materials would go to the balance sheet, all of those things that we have touched. And then for the income statement, all the various expenses, the labor expense, the two overhead expenses, all of those would go to the income statement as well. So with that, I hope this has helped to clarify the different budgets we would see in the master budget. Thanks for your time, and I look forward to talking to you in our next session.